Welcome to Geojit Spotlight. In this episode, we bring you the expert insights into the market with Dr.V.K Vijayakumar, Chief Investment Strategist, Geojit. He will share his views on whether there's a shift in the current market trend, the impact of GST reforms on the economy and the market, and how Trump's tariff could affect global markets. Most importantly, he will outline the ideal investment strategy for investors in these uncertain times. Welcome, sir.
Thank you, Abhilash.
So after the COVID crash of 2020, the market delivered impressive returns to investors for 4 years. But during the last 1 year, returns are very poor. Why is this so? Do you see any change in the market trend going forward?
Yes, during the last 4 years, particularly from 2020 March to 2024 September, we had a roaring bull market. The Nifty galloped from 7,511 in March 2020 to 24,277 in September 2024. This roaring bull market gave excellent returns to investors. Many stocks multiplied 4 times, 5 times, 6 times. Many mutual funds gave excellent returns, particularly in small caps and mid caps. But this roaring bull market is over. I'm not saying that the bull market is over. The bull market is very much intact. It will continue with the occasional dips. But the roaring bull market in which the Nifty more than tripled in 4 years, that is over. That is not normal. From now on, we can expect modest returns. Now, why do I say expect only modest returns? The reason is a bull market, if it is to sustain, it should have fundamental support from earnings growth. The 4-year rally had fundamental support. During this 4-year period, FY21 to FY24, the earnings grew at 24% CAGR. 24% compound annual growth rate in earnings is great fundamental support. So the market simply galloped. But what happened last year? There was a dip in GDP growth and also there was a sharp dip in earnings growth. Last year, FY25, earnings grew only by 5%. In contrast to the 24% average earnings growth during the 4 years before that. So when earnings growth decline, prices also decline because valuation goes up. So when valuations became very high, Nifty valuation shot up to 22, 23, very high valuation. So what happened? FII started selling big in the Indian market. Last year, calendar year 2024, FII sold equity worth 1,21,210 crores. This year, up to August 31st, FII sold equity for 1,70,940 crores. Massive selling. Why are they selling? Because the valuations are high in India and the valuations are much cheaper. And only earnings growth is much higher in China, in Hong Kong, in South Korea. Therefore, they are selling here and moving the money out. Very rational thing to do. The India valuations have been keeping high, maintained at a high level because of this sustained flow of money through the mutual funds. So, and this is the reason why the market declined from the peak in September 2024. Decline in GDP growth, decline in earnings growth. But then things are going to change very soon. When exactly we cannot change, say the reforms, the many reforms that are being implemented by the government is going to push up India's GDP growth and earnings growth.
So what will be the likely impact of GST reforms on the economy and stock market?
Well, GST has been a game-changing reform. The summary of GST reform is the 4 tax rates, 5%, 12%, 18% and 28% has been reduced mainly to 5% and 18%. And there is another 40% only for sin goods like tobacco, pan masala and super luxury items. So most of the commodities that we consume will come under the 5% like FMCG or 18% like automobiles, consumer durables, etc. So these segments will stand to benefit substantially as a result of GST reforms. And also we have to see this GST reforms as a part of the reform package the government is implementing. This year, we had that great budget which exempted incomes up to 12 lakhs from income tax. For salaried people, 12.75 lakhs. Then the Monetary Policy Committee, under the leadership of the dynamic RBI governor, is implementing a rate cutting cycle. Interest rates have been cut by 1%, and cash reserve ratio also is being cut. So along with this, now we have this GST reforms. These three policy stimulus have the potential to push up India's GDP growth, which will naturally get reflected in earnings growth also in the next year, FY27. This year, FY26, expect only 8% to 10% corporate earnings growth. But in FY27, things are going to change. You can expect more than 15% earnings growth. Then we will have a rally in the market when the market starts responding to this expected earnings growth in FY27. As I said, most of the fast-moving consumer goods fall under the 5% tax. So there will be a reduction in the price from 12% tax to 5%. But the biggest beneficiary will be the consumer durables, the so-called white goods, and that too particularly automobiles. When the tax on automobiles, two-wheelers, scooters, motorcycles, smaller cars, when they are cut from 28% to 18%, there is substantial price reduction. This will boost the demand, and therefore companies, even when they pass on the entire tax benefit to the consumers, demand will increase disproportionately and they can sell more. These are commodities with elastic demand. You cut by prices by 10%, demand will increase by 15%, 17%. So companies will sell more, the revenue will increase, profitability also will increase. So these segments, automobiles, two-wheelers, cars, smaller cars, all these companies will benefit. Do you want the names of companies? We have already discussed that. In fact, even before this, we have been strongly recommending stocks like Mahindra and Mahindra, Maruti, Eicher Motors, TVS Motors, and also Hero Motors in two-wheelers. These are the segments which will be benefiting substantially as a result of GST reduction. In FMCG, all the FMCG companies like Hindustan Unilever, Dabur, Godrej Consumer, Britannia, all these companies, Nestle, will benefit as a result of GST reduction. But the better growth prospects and profit prospects are in automobiles and consumer durables like air conditioners, refrigerators, washing machines, dishwashers, televisions, etc.
So how is the Trump tariff going to impact the economy and markets? Is there any room for optimism?
We have done some 3 videos, if I remember correctly, on Trump tariffs and its impact. Trump is a very mercurial person, totally unpredictable person. Today he will say something, tomorrow he will reverse that. It happened even 2 days back. Therefore, we should be focusing on not what President Trump says, but on what President Trump acts. Actions are more important. Something unexpected for Trump was the change in power equations when this secondary tariffs, penal tariffs were imposed on India. Suddenly we had big moves in the Shanghai Cooperation Organization, where Prime Minister Modi, President Xi Jinping, and President Putin came together. There was great camaraderie among them, friendship among them. That sent a very clear message to Trump. Therefore, there must be some rethinking among the American administration also. But we can't be sure about it. Personally, I feel that the 25% penal tariff on India is likely to be abolished. It will be temporary, not likely to be permanent. But the 25% reciprocal tariff may remain. So let us wait and watch for what unfolds as far as Trump tariffs are concerned.
So what should be the ideal investment strategy during this uncertain period?
Well, when we think about investment strategy, we should always think about asset allocation. Asset allocation, as I have already explained, is deciding how much money should be invested in which all asset classes. This will depend upon different factors. This will be person specific. For example, many youngsters may be watching this video. People in their late 20s, early 30s, young people. They may be middle-aged people around 40 or 40s, approaching 50. They may be elderly people above 50, even above 60 or 70. The risk appetite of these people will vary because there is no direct connection between risk appetite and age, but generally there is a correlation. Therefore, young people with high risk appetite and a longer time horizon, the minimum time horizon, investment horizon of 3 years, they can invest in the market. Even bulk investment can be done if they have a 3-year time horizon. If they don't lose sleep when the market comes down by 5%. They can invest in equity. They can invest in equity mutual funds. They can invest in hybrid funds. Middle-aged people also, depending upon their financial goals and risk appetite, they can invest in equity. They can give priority to equity. Elderly people, if their risk appetite is low, they should be giving priority to fixed income. They can invest in multi-asset funds, mutual funds, for instance, which invest money in fixed income assets, gold as well as equity by reducing the risk of equity. This should be the investment strategy broadly. But when we are investing in stocks directly, valuation should be given importance. For the last 1 year, in many of the videos that we did, I have emphasized on the safety of large caps. Look at the situation now. To take the last 1 year, I am taking the last 1 year till yesterday. Nifty has delivered minus 0.65% negative return in 1 year. We had more than 24% CAGR, excellent return for 4 years, 1 year negative return, last 1 year. Mid cap minus 1.95% and small caps minus 8%, more than 8%. So valuations of small caps are very high, better avoid that. If you are very sure about the prospects of a particular stock, you can go for that. But this segment is overvalued. If you take the BSE 500 stocks, more than 200 stocks have a price earning multiple of more than 50. These are excessive valuations. Whereas large caps are fairly valued. Mid caps valuations are higher, but mid caps are doing well. From the earnings perspective, they have the fundamental support from earnings. So this should be the main ingredients of the investment strategy.
Thank you, sir. Thank you.